One of the more striking features of our present market is the distance between earnings and prices, a gap explained not by arithmetic but by psychology. In arithmetic, one examines corporate receipts, dividends, book values, one computes yields and ratios and arrives at conclusions which, if acted upon with discipline, provide a margin of safety. In psychology, by contrast, one observes the moods of crowds. The market, for a time, behaves like a voting machine, counting noses, preferences, fancies, and the price it registers at any given moment is a mere expression of popularity. It follows then that the market will at times accord to businesses a valuation wholly out of proportion to their ability to produce cash for the owner. That is the paradox I wish to discuss. The market is a voting machine until it is a weighing machine. The long-run correction comes, but between the two modes of operation lies a great deal of danger for the unwary and opportunity for the disciplined. Now let us observe the fact more closely. Companies produce value in the form of dividends, earnings, and, if one is disposed to liquidation, net assets. These are objective phenomena, yet the market consigns to them a price which depends often upon factors having nothing to do with output or capital. Public mood, credit facilities, tax considerations, even tales told by brokers in hotel lobbies will affect the votes cast for one security or another. In a speculative phase, these votes accumulate into high prices not because the business has increased its capacity to earn, but because purchasers, collectively and for reasons of sentiment, place a higher number on the paper. It may well be said, and I agree, that frequently the underlying psychology of the public does not change as quickly as the market price does. The public may have been sober for many years. It needs only an excuse to revert to its old speculative habits. When that excuse arrives, favorable reports, a new fad, the appearance of greater liquidity, people who once were cautious remit themselves to the crowd. They tell themselves that this time it is different, which is the most dangerous phrase in the financial vocabulary. We must, therefore, be precise. What do we mean by speculation and what by investment? An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Speculative operations fail to meet these conditions. This definition is not merely academic, it is practical. If you do not know whether you are an investor or a speculator, you have already assumed a risk you cannot assess. The man who assumes market risk in the hope of quick gains is not, in fact, following the precepts of security analysis. He is gambling. Now let us examine some of the common symptoms of the voting machine phase. First, yield compression. When the yield on stocks, measured either by current dividends or by payout ratios related to earnings, falls substantially below the yield on high-grade bonds, one has a warning signal. That warning is more meaningful if it arises not from a marked improvement in corporate dividends, but from a general rise in prices without corresponding increases in earnings. The yield on a stock is the market's statement of expected return. When it shrinks because prices have been bid up, the margin of safety vanishes. Second, the proliferation of stories and forecasts. In sane markets, one hears analysis of fundamentals. In speculative markets, one hears predictions. Earnings will grow at 20%. This industry will enjoy an exponential expansion. Technology will revolutionize returns. Forecasts have their place, but they must be recognized as guesses about the future. The future is, by definition, uncertain. Investors who attach undue weight to long-term forecasts and allow them to justify high prices are inviting disappointment. Third, the broadening of ownership to the unseasoned and the emergence of new techniques of financing. When a higher proportion of purchases are made on credit, or when new classes of investors enter without the background of careful study, the voting tendency strengthens. This is the moment when you begin to hear claims that the market has become a permanent source of easy money. At such times, the prudent investor should adopt restraint rather than enthusiasm. Consider now the method of analysis which will allow a man to withstand the excesses of the voting phase and to profit when the weighing begins. The central idea is intrinsic value. By that I mean an estimate, you might say a reasoned judgment, of what the business is worth if its future earnings and assets were converted in a calm and objective market into money. The estimate is not a single figure. It is a range. But it must be based on the facts available in the financial statements, assets, liabilities, earnings history, dividend record, and prospects that can be argued with some degree of rationality. If the market price is sufficiently below that estimate, the margin of safety exists. Illustrations are useful. In my practice and in the practice of those analysts whom I respect, one often seeks companies whose market quotations are materially below their net current asset value. that is, the current assets minus all liabilities and preferred claims, ignoring intangible items. The so-called net-net bargains of my day often occurred in depressed markets when fear had led to indiscriminate selling. Such situations are admittedly not common, but the technique exemplifies the principle. Buy where the price substantially understates the business's realizable value. Let us pause to reflect on temperament. The analytical method is necessary but not sufficient. An investor must possess a degree of independence and emotional discipline. He must be willing to think differently from the crowd and to hold when others scatter. He must, as I have written more than once, control himself. The investor's chief problem, and even his worst enemy, is likely to be himself. Fear and greed are the two great disturbers of sound judgment. It follows that the investor should prepare his policies in advance. This is not the activity of genius, but of caution. A simple, well-diversified portfolio for the defensive investor might reasonably be split between high-quality stocks and bonds, say 50-50, with permissible bounds of 25 to 75% in either category, depending on market conditions. The enterprising investor may deviate, seeking undervalued issues, special situations, or small company bargains, but only if he has the time, temperament, and competence to do the work. One must not attempt to be enterprising in a half-hearted manner. Half-hearted attempts to beat the market often lead to both worry and poor results. Now we come to the principle, if I may call it that, of margin of safety. The margin is the buffer between the price you pay and your estimate of intrinsic value. It is the central concept of investment. Buy at prices that afford protection against errors in calculation and the unforeseen. If your computations have a degree of uncertainty, and all computations concerning the future do, then the margin must be large enough to leave a cushion. For those who like examples, if your analysis yields an intrinsic value of $50 per share, do not be content to purchase at $49. Better to see a price of $30 or less, depending on how speculative the inputs are. The safety margin is not a mathematical guarantee. It is an attitude toward the unknown. Permit me to address an objection. Some say that the market, over time, will reward superior companies with higher multiples, and thus the purchase of a rapidly growing enterprise at a high price may yield excellent results, even if the initial margin appears small. This is true occasionally, but it is not a rule upon which a prudent man should rely. Growth is unpredictable. A business that grows rapidly for 5 years may falter in the 6th. The successful speculator may thrive on well-placed forecasts. The successful investor must depend upon fundamentals and a margin of safety. We must also speak of Mr. Market. He is a useful allegory. Imagine a partner who every day offers to buy your shares or to sell you his shares at a stated price. Sometimes his quotations are sane. At other times they are either euphorically high or despairingly low. You are not obliged to accept his offers. He is there to serve you, not to instruct you. If he quotes you a low price when, on your analysis, the shares are worth much more, you buy from him. If he quotes you a high price, you sell to him. Most of the time, however, you do nothing. You ignore his moods. This parable teaches detachment. The intelligent investor understands that the market's day-to-day pronouncements are often emotional, and that only by analyzing intrinsic value and being indifferent to the daily quotations can one profit from Mr. Market's erratic temperament. Let us consider, briefly and practically, the meaning of price-earnings ratios and dividend yields in the present context. The price-earnings ratio tells us how many dollars investors are willing to pay for $1 of current earnings. A high P/E ratio may reflect expectations of future growth or simply speculative enthusiasm. The dividend yield tells us what return in cash the investor receives in the present for his investment. When yields fall precipitously below those of high-grade bonds, one must ask whether the marketplace has substituted hope for tangible returns. Bonds, by their nature, provide contractual payments and a fixed maturity. Stocks do not. The prudent investor measures the two and avoids relying on the market's promise of perpetual growth to justify a narrow yield spread. Now let us observe the historical pattern. In our studies of markets over the years, we have noted that markets always tend to go too far in both directions. They overshoot on the upside and overshoot on the downside. The swings are larger than would be warranted by a sober analysis of the businesses themselves. Why is this so? Partly because the voting machine is a powerful device. A rising market gathers momentum. Increases in price attract buyers who hope to participate in the rise. Conversely, a falling market becomes a self-reinforcing calamity. Fear begets selling, which begets lower prices, which begets more fear. Hence, the necessity for rules to moderate behavior, a portfolio policy, a margin of safety, a disciplined procedure for buying and selling. We must not be content with exhortations to restraint without addressing some of the practical instruments that affect market psychology. One of these instruments is margin. Margin requirements, the amount of funds an investor must put up to borrow for purchases, have in past years of speculation been a means by which speculative excesses have been encouraged. Lower margin requirements permit larger positions to be taken with limited cash, magnifying swings. I do not suggest that margin policy be employed lightly. Rather, it should be considered as one tool. An increase in margin requirements made prudently and after consideration of the other effects on credit and commerce may be a reasonable first step to check a speculative boom. It is less drastic than measures which could interfere with normal business operations and yet may be effective in cooling the fever. Monetary policy and fiscal policy have roles as well. The Federal Reserve, by its control of credit, can influence the cost and availability of funds. Government deficits, if financed in ways that expand the money supply excessively, can be inflationary and thereby create a climate where equities rise as a hedge against loss of purchasing power rather than as a reasoned investment. I will not here espouse any radical program of control. Rather, I suggest moderation. It would seem reasonable for policymakers to recognize that the inducements to speculation increase when money is easily available and when the expected costs of borrowing are low relative to expected capital gains. There are also tax considerations. Capital gains taxes, their rates and timing, affect the willingness of investors to sell and rebalance. A high capital gains tax may lock investors into positions, which in turn reduces the fluidity necessary for market prices to reflect new facts. This, in its turn, distorts the voting machine by creating artificial reluctance to trade. Again, I do not propose that tax policy be dictated by the desire to control markets alone, but I do counsel recognition of the secondary effects of tax rules upon market behavior. Turning again to the individual investor, and I address myself to those who wish to be prudent, let me recommend a few practical rules. First, determine your objective. Are you a defensive investor or an enterprising one? If defensive, favor high-quality bonds and large conservative companies with a history of dividends and modest debt. Do not attempt to outguess the market. Keep diversification and rebalancing as your insurance against mistakes. Second, if you are enterprising, confine your efforts to situations where you have an identifiable advantage and can devote sufficient time and care. Look for special situations. Companies with valuable assets not reflected in price, firms undergoing temporary difficulties likely to be resolved, or small enterprises sold at prices below their working capital. Use the margin of safety as your guide. Do not imagine that you can beat the market by following fashion. Third, keep a record. I have found in the education of many students that disciplined record keeping of purchases and sales, and of the reasons, therefore, corrects innumerable errors of temperament. When the market is right and you are wrong, a record helps you learn. When the market is wrong and you are right, the record fortifies your courage to hold. A point frequently overlooked is the danger of over-diversification. Diversification is insurance. Too much is a confession of ignorance. If you hold 80 or 100 stocks, you can hardly have studied them. You may escape idiosyncratic risk, but you pay the price in mediocrity and in transaction costs. A sensible middle course is required. Enough issues to avoid a catastrophic loss from one misjudgment, but not so many that you cannot know them intimately. Permit me to reiterate an essential truth. To achieve satisfactory results is comparatively easier than to achieve superior results. Any thoughtful man who avoids serious errors and who applies the margin of safety will do well enough. To outperform the market consistently requires either skill beyond that of most mortals or a temperament and strategy that take advantage of the crowd's errors. Do not mistake the difficulty of consistent outperformance for an argument that markets are always correct. They are not. They are frequently wrong, but they are seldom wrong in a way you can predict on a given day. Let us now address the psychology more directly. Men are not machines. Their investments are colored by hope, fear, pride, and regret. When prices have been rising, one observes a gradual dilution of caution. The public's language shifts from reasoned talk of earnings to stories of inevitability. The man who a decade ago would have been too sober to buy now rationalizes his action with phrases like, "This time it's different." That phrase, as I have said, should arouse skepticism. When the market is falling, the emotions reverse. The same man now calls for capitulation and panic. He sells not because the business has changed, but because his neighbor sold or because the headline frightened him. This oscillation is the very substance of the voting machine. What can be done to strengthen the individual against these impulses? Education helps, but even educated men are not immune. Structure helps more. Predetermined rules for buying and selling, diversification, and an allocation policy. It also helps to view securities as ownership in a business rather than as lottery tickets. If you think of stocks as pieces of productive enterprises, you will demand sound fundamentals and a price consistent with value. You will be less likely to react to daily market votes. There is also the moral aspect. Honesty in calculation and humility in forecast are better qualities than cleverness in persuasion. A man who writes analyses intended to impress will likely do poorly as an investor. I have always believed, perhaps naively, that one should teach only what one practices. If you recommend methods that require special access, inside information, or questionable conduct, you are doing the reader a disservice. The average man in Pocatello or Peoria must use techniques available to him. He must be given rules that can be followed in a straightforward way. Let us now consider the profession as distinct from the private investor. Wall Street, by its nature, is forward-looking and therefore susceptible to fashion. Firms seek to attract clients. Brokers and managers are judged by their recent performance. This creates incentives that sometimes conflict with the long-term interests of investors. For the professional, fidelity to the basic tenets of valuation and to the client's mandate is the professional duty. But the temptation to chase performance is ever present. Therefore, institutional controls, clear mandates, prudent custodial oversight, and proper regulation of conflicts are essential. One must acknowledge that there are limits to what regulation can accomplish. The market reflects the sum of human judgments, and as such cannot be made perfectly rational by legal fiat. Nevertheless, there is a role for prudent public policy. Margin requirements, as I said, deserve consideration in times of speculative excess. Prudential supervision of brokers and dealers, limitations on misleading advertising, and transparent accounting standards reduce the opportunities for deception and for the institution of unjustified enthusiasm. I would also argue for the value of public education. Citizens taught the principles of intrinsic value, diversification, and the margin of safety are less likely to be seduced by fashion. Schools of business bear a responsibility in this regard. So do the press and the broadcast media when they cover markets. Sensational headlines and breathless reports do not contribute to a sound investment culture. Now, a few words on forecasting and its appropriate role. Forecasts of long-term economic growth, of technological progress, and of national policy are necessary for some aspects of planning. But forecasts about the short-term direction of the stock market are largely futile. The economy may trend upward for decades, while the market oscillates wildly about that trend. The investor who sells on the basis of a short-term forecast often misses the longer progress, and the investor who buys on a forecast of continuous rise pays dearly when the market corrects. What then do we do with forecasts? Use them as a background, not as a sword. They inform your estimate of growth rates and of reasonable ranges of earnings, but they should not be used to justify paying extravagant prices. The correct relationship between forecast and valuation is a hedged conservative one. Use the forecast to determine that a business may, under reasonable assumptions, continue to produce earnings. Then price the security in such a way that even if the forecast is wrong or optimistic, you retain a margin of safety. At this juncture, one must address the question of how one conducts purchases and sales in practice. There are several techniques. One may use dollar cost averaging, purchasing a fixed dollar amount periodically, which reduces the risk of poor timing and mitigates the effects of volatility. One may also use limiting orders, buying only when a price satisfactory to one's analysis is available. These are not panaceas, but they are procedures which assist discipline. It is folly to suppose that there exists a single mechanical method that will defeat the market consistently without sound analysis and patience. Let us turn to the inevitable question: when should one act? If the market is irrationally low relative to intrinsic value, it is the investor's duty to buy. If it is irrationally high, to sell or abstain. But how often does one find such clear dislocations? Not frequently. Therefore, patience is required. The investor must be prepared to wait months or years until mispricings occur. That is, in my judgment, the natural rhythm of disciplined investment. I should emphasize that real opportunities present themselves in special situations as well as in general market corrections. Corporate reorganizations, liquidations, and spin-offs sometimes reveal value not immediately recognizable in current quotations. careful reading of financial statements, attention to balance sheet strength, and an understanding of corporate tax considerations can uncover bargains. Yet these undertakings require time and expertise. They belong to the enterprising class of activity, not to the casual investor. Let me now offer a few aphorisms which, though simple, are useful. First, never confuse brains with a bull market. It is easy to look brilliant when everything rises. Second, avoid the lure of high yields obtained by taking high risks. There are two ways to get a high yield. You can own a stable company at a low price, or you can own a precarious one where the high yield is a reward for risk. Distinguish between the two. Third, never overlook the permanence of capital depletion. There is no quick path back from a loss of principal. To regain principal lost is to outperform exceedingly well for a long time. Therefore, preservation is paramount. Permit me to close, not with sentimentalism, but with a sober statement of principle. Markets, like men, have moods and distortions. There will always be periods in which prices outstrip the capacity of businesses to justify them. There will always be episodes in which fear drives prices below sound values. The intelligent investor's first protection is not foresight, but restraint. Build a policy, stick to it, seek value, demand a margin of safety, and be independent in thought. Do not be carried away by Mr. Market's enthusiasms, nor be forced to sell by his panics. Let your purchasing be businesslike. Let your selling be reasoned. Let your manner toward speculation be frank and separate from your investments. I leave you with this final practical instruction. Measure the quality of your portfolio not by its recent gain, but by the soundness of its components. If the earnings are real, the balance sheet conservative, the dividends sustainable, and if you have paid a sensible price, time is your ally. The market will, sooner or later in the long run, demonstrate the correctness or error of your judgment. Until that demonstration occurs, hold to the margin of safety, preserve your principle, and cultivate the temperament of a patient, independent thinker. Markets will continue to vote. In time, they will weigh. Be ready for both.